This is another exciting edition of Market Takes. I am Dion Rabouin, a reporter at the Wall Street Journal, and we are diving all the way into, the briefest speech, the most, straight to the point speech I think I've seen Fed Chairman Jerome Powell give. We are talking about his speech today at Jackson Hole, at the Jackson Hole Symposium. Man, 8 minutes, my man cut to the bone. He was right straight to the point. We're going to dig into everything he said and talk all about it. So we're going to talk about not only what he said, but we're going to talk about how the market reacted, the market reaction we've seen since the speech came out and since he delivered it, since he finished it. We're going to talk about the environment that we had coming into that speech, what the data was telling us before the chairman really took the podium and spoke, as well as how this changes things, what the outlook is going forward now that we've heard from Fed Chair Jerome Powell, and why this Jackson Hole speech is so important. I'm also going to tell you guys what's coming next. So we're going to dive into all of that right now. Look, the big message today from Fed Chair Powell was no pivot. We are not pivoting. I said what I said, and I meant it. Look, he's saying we are not going to stop raising rates until the job is done. As we had seen over the past couple months, markets had been pricing in a Fed reversal, a Fed pivot, if you want to call it, basically expecting that the Fed was going to hike rates through this year and then kind of take a pause going into next year, and then next year into the summer start to cut rates back down to help boost the economy. Fed Chairman Jerome Powell coming out today and saying in no uncertain terms that is not the plan. That's not what we expect to do. And you really got a very strong and, like I said, a dose of brevity from the chairman today. Fed Chairman Jerome Powell said, look, we must keep at it until the job is done. That's a direct quote. He referenced Paul Volcker, the Fed chairman who's known for whipping inflation in the 1980s, raising rates all the way up to around 20% to get inflation back down. The Fed chairman who's known for causing a painful recession in the 1980s and who really was not popular at the time that it happened. Fed Chairman Jerome Powell today referencing him 3 separate times. He said a restrictive policy stance could be appropriate for, quote, some time, meaning that, hey, you know what, you guys who are expecting us to just raise rates and then cut them back down again, that's not happening. That's not what we got going right now. I think it's really important to sort of look at this from the context of different markets and how they responded to that. We're going to get into it. I want to read a quote really quickly from Brian Coulton. He is the chief economist at Fitch Ratings, and he said something that I thought was really interesting. He said, quote, "This was a clear pushback on market expectations of a pivot from the Fed in 2023. After being surprised by the intensity and duration of inflation pressures over the last 12 months, the Fed is now clearly determined to make sure high inflation does not become embedded." Look, this is what the Fed has been saying. This is what Powell has been saying. Markets really weren't listening. At least the stock market wasn't listening. It seems like if you're looking at the market today and you're seeing all that red, the market clearly was listening. Last thing that Brian Coulton said was the Fed is clearly not going to be swayed by volatility in gasoline prices. The big reason we've seen a lot of the step down in not just inflation, but inflation expectations has been the decline we've seen in gasoline prices. We have seen gas prices decline for about 70 days so far, going on 3 months, where gasoline prices just steadily decline, even as the price of oil has been a little bit more volatile. The price of gasoline at the pump has been declining. That has been changing consumer expectations of inflation and overall consumer expectations. This Jackson Hole speech was big, not just because it set the tone or set the tempo on that pivot. This is the Fed's one chance to really communicate with folks from around the globe. Central bankers from around the world gather at Jackson Hole, Wyoming, discuss monetary policy. The theme of this year's event was all about the limits for policy and what can be done on the economy. And Fed Chair Jerome Powell really very clearly drew a line in the sand, said, listen, we're not backing off. We are not going to stop until the job is done. And this was an important place to make that message and to make sure it was received. 8 minutes, less than 9 minutes, the chairman spoke and got straight to the point and said and reiterated a number of times the point that he was making, which is that the Fed is not going to stop until inflation is under control. and that could be in 2023. It might not be till 2024. He said the Fed is not going to take their foot off the brake, I guess, is how you could look at this. So look, when we go into WSJ.com, we check the market data, you were seeing, if you're looking at the stock market, you were just seeing stocks plummeting right now. You've got the Dow down almost 2%. The NASDAQ down 2.7%, the S&P 500 down more than 2%, about 2.2%, and that's all been since the Fed chairman stopped talking. Actually, when the speech with text was first released right before he started talking at 10 a.m., you saw the market sell off. Then you saw the market actually come back while he was speaking, as folks kind of said, maybe this isn't so bad, let's buy. And you saw each of those indexes, the S&P, the NASDAQ, the Dow, all get back to about even or zero on the day. And then since then, there's just been a massive sell-off, and we're seeing now the NASDAQ down almost 3%. Bond yields, a much less dramatic reaction, because the bond market really had been listening to these Fed speakers, had been looking through some of the documents that have been released, and the bond market had sort of been seeing, okay, we don't think this pivot is really going to come. If you've been watching bonds over the past couple of weeks, the past 3 weeks really, since the Fed's last meeting, you had seen a significant pickup in bond prices, bond yields kind of picking back up, or sorry, a turn down in bond prices, bond yields picking back up, moving higher, and you saw that today. Now the bond market's saying, this was about what we expected. We didn't think the Fed was going to be done. We thought that they were going to keep raising rates and keep rates high. I think that's really the big thing here, is even if the Fed's done raising rates next year, they're going to keep them there up around that 4% level potentially, maybe even higher than that. As we've heard some Fed officials say, 4% is significantly more restrictive policy, that's tighter policy from the monetary side than we have seen in a generation. You have to go back before the 2008 financial crisis to get to a time when US interest rates were that high. And they haven't stayed that high. Again, if you remember back to 2018, the Fed tried to raise rates. Fed Chairman Jerome Powell said, you know, we don't think rates are at neutral yet. We've got a long ways to go, when the Fed was at 2.25%, which is right about where we are now, by the way. The Fed chairman said, we don't think we're anywhere close to neutral. We don't think we're anywhere close to done. We've got a lot more to do. The next month they raised rates again. That was the last increase that you saw. They reversed course by the end of the year. Start of 2019, they had started cutting rates, and that's what the market expected to see again. Fed Chair Jerome Powell saying, nah, not this time. And the bond market seems to have priced that in. So you're not seeing a big move from bonds right now. When we look at Fed fund futures, you're not seeing a big move there either. You're seeing a slight tweak in expectations for a rate of a 75 basis point hike at the September meeting rather than a 50-point hike, which had been factored in about a week or two ago. So over the course of a week, you're seeing a move more towards 75 basis points, or 3 times the normal rate, versus 50 basis points, or 2 times the normal rate. And that change has happened over the past week or so. But today, not a huge move on Fed fund futures, not a huge move in the bond markets. You are seeing a bit of a tightening from the yield curve. You're seeing 30-year rates, those long-term bond yields, coming down a little bit more than those short-term yields. And that's just a little bit more of the market saying, we're uneasy. We think this might be a little recessionary. We think the Fed might raise rates a little too far, cause a recession. But overall, right now, the market, the bond market at least, is saying, we think that Jerome Powell and the Federal Reserve have things in good control, and we are not that worried. You saw commodities, oil prices jump, gold jump during the speech, and then just like most other markets, sold that off later. So we're seeing commodities overall down right now, just like we're seeing a lot of the overall market down. Commodities prices, let me check here on WSJ.com. We're seeing crude oil down just a little bit. Brent crude down a little bit more than US WTI. Gold is selling off. Silver is selling off. But natural gas is up about a percentage. Natural gas looking unstoppable right now. Reached record highs recently, looking like it's going towards around $10 on the futures market. And that's something that I think folks ought to keep an eye on, because that's going to impact utility costs. But anyway, not to get lost, we are sticking with the Fed and the market reaction overall today. Right now, most things on the downward slide, moving lower. The dollar actually got a bump, and I think what's really interesting is if you look at the WSJ dollar index versus the overall USDXY dollar index, you're seeing a significant difference in terms of after Fed Chair Powell's comments, the WSJ dollar index went up, the overall US dollar index went down. And the big difference there is the WSJ dollar index measures dozens of currencies versus the dollar. The overall USDXY index measured versus just 6 currencies, the biggest one being the euro. Euro got a big bump today from some ECB policymakers over at the European Central Bank saying that they were prepared to do even more to raise rates by maybe 75 basis points, which would be really kind of historic for that central bank, which has been incredibly dovish, aka kept policy rates low, kept interest rates low and even negative for quite some time. So the takeaway, the market was a bit unsure. Powell came out, he was strong today. He said very clearly, we are not pivoting, we are not turning around and cutting rates next year. You guys better be prepared for us to do this for the long term. Bond market had kind of factored that in. You're seeing a little bit of price movement there, but the stock market clearly had not. And a lot of that bullishness that had been factored in to markets since, that June 16th low that we had seen in the stock market, and we've kind of taken off from there, that looks to be fading out of the stock market right now as investors factor in a tighter, a more, a Fed that's more committed to keeping rates high. Listen, we had seen this happen, this difference in markets, whether it's the dollar, whether it's bonds, whether it's stocks. The dollar rising higher lately is something to definitely keep an eye on because that could help keep inflation, that could help keep a lid on inflation, keep inflation down. We'd seen that trend reversing as folks in the market got more bullish. And that was one thing we did a video dispatch or a story here on YouTube about a week ago about how that weak dollar could undermine sort of this soft landing thesis that the market had priced in. Well, it looks like we may not get that. And so if the dollar remains strong, if the dollar continues to hold up here, that could be another thing that helps keep inflation down. And that could overall be good for the economy, though could be another factor weighing on the stock market. Definitely keep that in mind. The data we got earlier this morning, also important because it tells us a lot about where Powell's head was and what the Fed is thinking. Consumer confidence has been consistently rebounding. A lot of that has to do with the price of oil and the price of gas coming down at the pump. We saw continued improvement from the Consumer Confidence Index from the University of Michigan, came out early this morning, again, even higher than earlier this month. Since hitting that low in June, we've seen consumer confidence continue to pick up since hitting that 50 mark, and that really has coincided right along with the decline in gas prices. So as gas prices fall, inflation expectations have fallen and consumer confidence expectations have continued to rise and go up. Folks feeling a lot better about their economic situation as those gas prices continue to come down. Retail sales, remember, that was up just ever so slightly, up 10% year over year, but month over month, about flat, but up just ever so slightly. That was a strong number. And remember, we saw that strong jobs report for July at the beginning of August. Next week, we will be right here talking to you about the jobs numbers. Those strong jobs numbers, though, starting to worry the Fed. You saw Atlanta Fed President Raphael Bostic this morning kind of come out and say, we're not loving these strong jobs numbers that we've seen, which is an interesting thing to say from a policymaker. So keep your eye on that. If the Fed starts to talk more about how the jobs numbers are too strong, that could be something that really moves the market as well. A strong jobs report next week could actually move the market lower if it looks like that means the Fed has to do more work. So taking a step back, we are rolling towards the end of Market Takes here, and I want to thank you so much for being with us. Again, I'm Dion, Rabouin, reporter with the Wall Street Journal. Let's step back and just talk about the takeaways. Fed Chair Jerome Powell, strong, resolute, banging the table, pounding the table. We are not done. We are not pivoting. We are going to stay strong. I'm going to be like Paul Volcker and whip inflation. That's what he said today, and the market reacted. Powell is not on board with the Fed pivot, and that's why we're seeing stocks decline, because higher interest rates make it more expensive for companies to borrow, makes it harder for them to grow and expand, and more expensive. And again, these companies, these high-flying tech companies, their future cash flows, their future profits are discounted when interest rates are higher. This was a bit at odds with the minutes from the Fed's last meeting that were released last week. But you know what? If you've listened to Fed speakers over the past couple weeks, they have been singing the same tune. They're saying, we are not done. We are not reversing course. And Fed Chair Jerome Powell today came out and said that very strongly. So what comes next? We get more data. The Fed Chair Powell also said we are going to be data dependent. We're not locking anything in, 75, 50, no matter how many. We're not going to say right away today, we're going to do this in September and then we're going to do this going forward. He says, we're going to look at the data because they're, I think, very wary right now of getting another surprise high inflation report, of being surprised with another continued growth in the jobs market. So be sure next week that you are right here with us on Market Takes. We are going to be opening up and diving into the jobs report that we get at the beginning of September for August. So we'll be talking about that. Also, the CPI report is going to be big. And of course, next week, we get the Case-Shiller home prices report. We get another report on consumer confidence and the JOLTS jobs report. That's going to be big. So be sure and make sure you're watching that data, and be sure you're with us here on Market Takes next week as we dive into that jobs report. Look, I would be remiss if I did not take this opportunity to say a fond farewell and a salute to Kansas City Fed President Esther George. She's retiring at the end of this year. She has been very entertaining for those of us who watch the Fed. She has been a strong dissenter against policy when everybody else in the Fed was on board with cutting rates, with more quantitative easing, with providing more support for the economy. Esther George said no. It didn't really do much. They went ahead and did it anyway, but she has been a very interesting person to watch, a strong voice for tighter monetary policy for the hawks out there on the Fed, and for years of service. This will be her last Jackson Hole Symposium as president of the Kansas City Fed. So I just wanted to send a salute and a strong goodbye to Esther George. Shout out to her and the rest of the Kansas City Fed team out there. Very interesting to see who's going to be the next president that comes in there. That's going to do it for us here on Market Takes. Thank you for being with us. I know you could have been anywhere in the world, but you were here with me, and I want to say I appreciate you for that. We will be here next Friday when the jobs report is released. Please come back and join us then. I'm Dion Rabouin, and I hope to see you when we're right back here on Market Takes.